This week influenced by the Fed's interest rate hike. When the U.S. stock market fell, BTC surged in the opposite direction unlike before. Many people say that this is a historic and great decoupling. This indirectly indicates that the status of the crypto market in people's minds is gradually solidifying, and they have confidence in choosing it as a safe haven asset. The theory is gradually approaching reality, and the golden era of crypto may be slowly opening up. Nowadays, with the development of industry infrastructure, especially the high attention paid to ZK technology, the privacy and identity track is gradually gaining momentum, indicating that the industry is also preparing for the incremental market, the realization of entering the era of information privacy that was mentioned before is also not far away, and the future of Web3 will become much clearer. Web3 Current Affairs Update still brings you an overview of these hot topics that have sparked the industry. After a surge this week, the market took a hit due to the impact of the U.S. Federal Reserve's 25 basis point rate hike on March 23rd, causing BTC to drop from its high of $28,000 to around $26,700 before slowly rebounding to $27,600 currently. Based on the market's performance and the impact of the rate hike, as well as the SEC's charges against Coinbase and Justin Sun, regulatory issues are likely to continue to affect the market, resulting in a volatile state. The market is expected to slowly decline over the next week, starting from the next 2 days, but in the future, BTC will do a good job of hedging against the upcoming superinflation, so there's a high probability that it will go up in the future. ETH followed a similar trend, falling from its low of $1,819 to $1,719 after the rate hike news, and currently showing a slight rebound to $1,750. There is no change in the plan for the Shanghai upgrade of the mainnet on April 12. Subsequently, Go3M released the Ethereum client Geth v1.11.5, which will be activated for the Shanghai mainnet upgrade at 6 hours 27 minutes and 35 seconds on April 13 Beijing time. A recent report from the White House has criticized digital assets, stating that they provide no benefits and that cryptocurrencies have almost no value. The report also expressed skepticism about the possibility of a U.S. central bank digital currency CBDC. However, the U.S. has faced problems in the past with bank failures, and there may still be hidden risks lurking due to the lack of transparency in the banking system. Ultimately, the problems arose from the massive QE stimulus and the issuance of U.S. dollars, which the banks used to buy junk long-term bonds, leading to bank runs. The real risk to the banks lies in the U.S. bonds they purchased. Hyperinflation is on the horizon, and the rest of the world will once again foot the bill for the U.S. The crypto industry has become a convenient scapegoat for the serious consequences that have gradually emerged from the previous excess issuance of U.S. dollars. The industry is unstable and unregulated, so the recent harsh stance and confrontational attitude of the U.S. towards the crypto industry are purportedly for the sake of public economic security. However, it is unclear whether this is just a prelude to finding a scapegoat when the storm arrives, blaming the industry that caused the panic, collapse, and fraud, while claiming that they have already warned and taken appropriate regulatory measures to protect consumers, investors, and other financial systems. In theory, cryptocurrencies should be negatively correlated with the U.S. stock market and used as a hedge against risk, but in reality they are highly correlated. However, the recent performance of BTC has gradually begun to correct this relationship, with BTC soaring in the opposite direction. When the U.S. stock market falls, this phenomenon actually indicates that BTC, or the crypto market, is gradually gaining a stable position, and people have confidence in choosing it as a safe haven asset. The theory is gradually becoming a reality, and the gold era of crypto may be slowly opening up. On March 18th, Vitalik published a post discussing some ideas about choosing guardians for multi-signature and social recovery wallets. Multi-signature wallets have always provided a simple and secure way for us to self-regulate funds, and Vitalik himself uses a multi-signature wallet to manage his funds, as does the Ethereum Foundation. Social recovery wallets are more user-friendly than multi-sig wallets. It only has one private key, and if this key is lost, it can be recovered through other specified private key holders. He suggests that social recovery wallets can be used to store small amounts of funds in hot wallets, while most of the funds can be used in cold wallets through multi-signature, which can also be more convenient and secure. Nonetheless, it will also bring about a common issue. Both of these technologies necessitate the presence of guardians. Multi-signature wallets often assign n-guardian addresses, and an operation can be agreed upon if m-guardians sign. Just one private key may be used to sign social recovery wallets. But if the private key is lost, an out of m-guardians must sign a message to restore the private key. Thus, deciding on guardians and protocols is a challenge. We need to ensure that they do not lose their private keys and do not collaborate or are compelled to conspire. Therefore, guardians should be unconnected to one another. Vitalik offered specific recommendations. 1. Some guardians can be their other devices, but not too many. 2. It is best for guardians to be unrelated to each other and have as little connection as possible, and not in the same city or country. 3. Guardians should ask a security question before agreeing to an operation. 4. If it is urgent and there are some instant operations, it is best to choose guardians who can quickly respond to you, regardless of time zone factors, etc. 5. Test each guardian at least once a year to prevent them from forgetting or losing their account. Vitalik stated that, in terms of privacy, the financial privacy of your account cannot be kept confidential from guardians at present. But technology can solve this problem. Guardians do not directly protect your account. They protect a safe deposit box contract, and the link between your account and the safe deposit box is hidden. It is very easy to keep the link hidden before recovery is needed. For example, your account can act as a guardian and have a create to contract that can only be created by the safe deposit box. However, even after recovery, more advanced zk-snark technology is needed to keep the link hidden. Therefore, he expects this issue to be slowly resolved over the next few years. The Web3 identity privacy space is gradually opening up, signifying a data sovereignty era. The promotion of self-sovereign private data is one of Web3's most essential early principles, with conventional Web2 companies abusing user data. This approach is one of the most appealing parts of Web3. The private identity area is steadily expanding, signaling that the industry is also ready to service the incremental market with the comprehensive development of industry infrastructure. Particularly the high attention given to ZK technology, it is very crucial to provide consumers with a better experience, beginning with their fundamental identification. And the application possibilities are rather extensive, with broad coverage in contact regions, as well as increased loyalty and usage rates. Aspecta, a Web3 developer identity authentication platform, has gotten funding as well. Aspecta may provide AI-based identification profiles for creators, allowing the community to learn about their abilities. Structured data on the chain is further created by using algorithms to glean hints from how users' wallet addresses interact with smart contracts and the relevant activity kinds. Aspecta is now linked to GitHub, the Polygon ID project, which has been highlighted several times in prior issues. Recently cooperated with Sandbox to improve its KYC program, recapturing the public's interest. Polygon ID will be packaged using IDEN3, a decentralized identification protocol that employs zero-knowledge proof technology. Validators may validate personal credentials without accessing personal information, allowing them to move real-world identities to Web3 while safeguarding user privacy and satisfying regulatory KYC (AML) standards. Owners may also store several credentials from various issuers in a single wallet to create their own multidimensional identification system, equivalent to having an ID card, social security card, and driver's license all in one. Also, The identification of diverse roles and asset movements on or off the chain has been improved with the deep integration of Polygon's EKEVM and the inclusion of Polygon ID. Web3's future is becoming clearer, and the era of information privacy is also expected to emerge in the near future. To market-making platforms, Oros and crossover markets have raised funding since the collapse of FTX market maker Alameda. There has been a pressing need for a strong liquidity provider platform in the crypto market recently. Oros and crossover markets have gained market attention as market makers. Oros lost $20 million due to FTX's bankruptcy and received $17 million in financing from Vivian Court Trading and BitDigita during a major debt restructuring. Vivian Court Trading is a high-frequency trading firm for stocks and derivatives based in Sydney, while BitDigita is in the Bitcoin mining industry. Crossover Markets is a digital asset trading technology company that recently launched a new trading platform called CrossX, whose main purpose is to solve market liquidity issues. In previous disclosures, they have received $6.35 million in funding from investment firms such as Wintermute Ventures, Laser Digital to Sigmund Flow Traders. This shows that the Web2 industry is paying extra attention to the Web3 crypto market-making industry. LSDX Finance, second farming of LSD derivatives. LSDX Finance focuses primarily on second-layer collateralization of LSD derivatives from Lido, Rocket Pool, and Frax Finance to earn LSD rewards. The platform currently supports ETH, Steth, FERXIT, and our ETH as collateral, with a displayed TVL of 54,447 ETH according to the website. Financing news of innovative projects. Teleport to Carbolibus Wallet. Teleport DAO. Teleport DAO aims to achieve cross-chain data transactions across multiple EVMs, with its main contribution being to support the integration of Bitcoin and Polygon, and to create a Bitcoin Oracle trading market. Carbonable. Carbonable is a carbon offset tracking platform on Starknet, and its project mainly focuses on offsetting carbon emissions by purchasing carbon credits. Sol Wallet. Sol Wallet is a wallet company established by Zheng Jiajin, a former product manager at ByteDance. Its main focus is on the wallet custody system established for the new standard ERC for 337, which aims to address the shortcomings of wallet accounts and improve user experience. That's all for this time. We'll see you next week.